The history of QES Berhad can be traced back to 1991, where it was first founded by Mr. 𝗏 and his 4 partners. However, over the years, the 4 partners disposed their entire shareholdings to Mr. 𝗏 and 𝗏𝗠𝗏. Since then, both Mr. 𝗏 and Mr. 𝗏 had led the company as managing and executive director till this day. The company claims to be in the automated testing equipment industry, where they specialize in manufacturing, distribution and provision of engineering services for inspection, tests, measuring, analytical and automated handling equipment to the electrical and electronic, automotive, semiconductor and many other industries. Some of the countries they sell to are the ASEAN countries, which represents about 89.7% of their total revenue for financial year 2020, 6.7% comes from the Northeast Asia region, and the remaining 3.6% comes from other countries. For more information, you can visit their website at www.qesnet.com. A choppy but growing revenue, while gross profit didn't grow much after the decline in financial year 2017. This is not stated in the slide, but I just want to highlight that the company's distribution division revenue has a product mix variance which consists of high sales volume but with low margin, while their manufacturing division has a higher gross profit contribution. This means their manufacturing division contributed better gross margin than their distribution division. Their little to no growth in gross profit had led their operating profit to yield the same outcome. The times where they achieve growing in operating profit is when gross profit is improving, and vice versa. Notice gross profit margin dropped in financial year 2017 despite the rise in revenue illustrated in the previous slide. That's actually because they sold more products in their distribution division that yield lower gross margin. On the other hand, a large drop in operating profit margin and net margin in financial year 2019, it is due to the lower sales and gross profit. Similar outcome to their ROIC, dropping massively in financial year 2019. Thankfully, there was a turnaround after that. Personally, I feel the management has been overpaying themselves. Despite the inconsistent profit after tax delivery, their remuneration has been on the rise. The highest remuneration to PAT ratio was 160% in financial year 2019, while lowest was 14% in financial year 2016. Nevertheless, QES has a very healthy cash to debt ratio, plus cash is growing even faster after they had raised fund from IPO. Great operating cash flow overall, as they grow in tandem with CAPEX. Drop in operating cash flow in financial year 2015 and 2017 to 2020, it is due to the increase in working capital. QES only paid dividend for 1 year. It makes sense since they are still new and relatively smaller than the Tier 1 ATE companies like 𝐕𝐶𝑥, 𝐕, etc. So focusing on business expansion is the right move. Thanks to their superb operating cash flow, it allowed them to achieve a positive free cash flow over the years, though the growth was choppy. All in all, I rate their company 3.4 out of 5.6, which is about 60.7%. After analyzing QES 10 years of financial data, here are my thoughts. Number 1. Although many declared QES as an ATE company, personally I view them differently. Based on their revenue contribution by business segment, about 85% are from the distribution division, where they help market and distribute equipment that is already built and supplied by various foreign manufacturers. However, only 15% of their revenue comes from manufacturing division, which is what most ATE company does. Basically building automated test equipment. For example, 𝗕𝐷 builds machine vision inspection, 𝗦Tech builds wafer-level chip-scale packaging sorting machines. That said, there's a fine line between a distributor and manufacturer. So for those who think QES is a small ATE company, you may want to reconsider again. Besides that, if you pay attention to their profit margins, it is quite similar to the players in OSAT, EMS and second-tier ATE companies. In my opinion, I doubt their margins will improve any further since majority of their business comes from the distribution division that brings them lower profit margin despite a high sales volume. But of course, the higher profit margins can be achieved if they expand their manufacturing division. Lastly, I feel that the management had overpaid their remuneration in most years, with the exception in financial year 2016, which is around 14% of its profit after tax. Based on their direct competitors' remuneration to PAT ratio, 𝗏𝐶𝐿 stands less than 0.5% on average, while Chemtech sits at 13%. Nevertheless, this can easily be offset provided the management is able to deliver a stronger net profit in the next few financial years. That's all for today's video. Hope you guys enjoyed the analysis. If you did, make sure you smash the like and subscribe button. If you have any questions, feel free to comment down below. I'll be happy to get back to you. With that, I'll see you in the next one.